Hi there. Welcome to the Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Canadian home sales edged higher in April as lower prices and the arrival of the spring housing season brought more buyers back into the market. According to the Canadian Real Estate Association, national home sales rose 0.7% from March, while the benchmark home price slipped 0.1%. That's the slowest monthly decline since October. And shares of Canada Goose are up in the pre-market. The parka maker reported higher quarterly revenue and a modest increase in profit as demand for its luxury outerwear remained strong. The company says sales rose 18% in its latest quarter, while adjusted earnings also improved from a year ago. And Manulife Financial posted first quarter earnings that slightly missed analyst expectations, though the insurer continued to see growth in its international business and wealth management operations. The company highlighted momentum in Asia, where core earnings rose 22% year over year. And we're watching the markets, of course, today. The S&P 500 reaching a new record high yesterday. So far in the pre-market, up by 0.2%. The Dow up by almost a full percentage point this morning. Not the same story for the TSX to end the day yesterday. It lost a couple hundred points. So we're going to watch to see if there's a rebound today. Still ending the day yesterday at least above 34,000. An upswing in U.S. stocks looks set to continue after Wednesday's tech-driven rally led the S&P 500 to a new record. Our next guest says the stock market is pricing in an end to the war in Iran. So let's get more now from Ryan Bellinger, founder and managing principal at Claro Advisors. Good morning. Good to have you join us.
Good morning.
Should the market be pricing in an end to the war in Iran right now?
I think so. I mean, the markets are very forward thinking, and so they're well in advance of what's happening today, tomorrow, or even next week. And it seems a good train of thought that this is not going to be a war that goes on for years. There's hopeful to be some progress coming out of the summit in China this week. So we're hopeful. It seems the market has kind of fully priced in what could happen with oil. And it has been a fantastic earnings season. And so I think a lot of investors are focused on that. I mean, you've got the S&P earnings up almost 20%, and that's almost twice what the past decade was. So it's fantastic. These companies are earning so much. But, from a bear case, typically that's very rare. We're not coming out of a recession or anything like that. We are a late stage bull market. And when you have such an advancement of earnings at the late stage, it does coincide, unfortunately, with 3 or 4 other times in history where it's turned out to be the peak of the market. I'm talking about, it's 1973 or March of 2000 or even the early 2007. Similar earnings characteristics after a long bull market.
Yeah, let's talk about that. The S&P 500 making small new time highs. What do you think the lesson is for investors here when you watch what the S&P 500 is doing this week?
Yeah, I mean, it's critical for investors to be diversified in their portfolios. I think many people don't fully understand how much technology that they truly own. They own the S&P 500, but it's a considerable overweight to technology. It's very concentrated. And so you just can't mistake being diversified for owning the S&P 500 anymore. You've got to be in international markets. You've got to go down the capitalization structure and own small caps and mid caps. I mean, small caps have been very out of favor. They've rallied recently, but I'm talking over the last decade that they've underperformed. And so we encourage investors to really broaden out their diversification and not just think of it as owning the S&P 500.
I want to talk about broadening out and diversifying a little bit, but just first of all, when we're talking about big tech, are you optimistic about big tech for the rest of this year?
Yeah, we are. It's that part's much different than the dot-com boom. These companies are generating huge amounts of free cash flow, and that's a huge distinction. One caution is that it's a lot of CapEx. They're spending tons of money trying to buy compute and data center. And so, does this materialize? Eventually, they got to make some money from this. And so I think that's really what investors would be wise to watch was, are there any signals that this might not go as according to plan? And there's going to be new winners, kind of each month. You've seen the rise in Anthropic versus OpenAI. I mean, who could have predicted that even just 6 months to a year ago? So you've got to be, really watching what's going on. And but broadly speaking, we do still like technology.
Is there a worry that when we see, because obviously what you started off talking about, like a strong earnings season, particularly for some of these big companies, is there a worry that what we've been seeing over the last couple of months with the conflict in Iran, the higher energy prices, we'll see that reflected in the next quarter?
Certainly. Yeah. I mean, there's been a lot of chatter about that on earnings calls. You've seen the spike in oil show up in inflation for sure. And so I think that's where a lot of people are focused. But even the core, the ex food and energy, inflation was up too. So, that's still a big concern. I think, these companies they really can't be focused on or hoping to get rate cuts. I think that door is closing quite fast. And now you've almost got to wonder whether we're exposed to a rate hike. And I think that's the world where you really don't want to get into. That reminds me, just from history's perspective, of the 1970s, where they really just couldn't figure out, they didn't quite fully get the inflation fire stormed out. And then they had a decade of lost earnings for investors. I certainly hope that we're not signing up for that.
Mm-hmm. NVIDIA, well, that's what we're watching for next week, reporting earnings. What are you watching, or what are your expectations coming out of that report?
NVIDIA has been an interesting stock. It's kind of been a laggard. If we had talked a week ago, I could have said that with more confidence. Now you've seen a big surge recently. I think the stock's gone up quite a bit. It's finally kind of catching up to some of those other names that have really been accelerating quite quickly. So I don't want to say it was forgotten, but I think it was the dominant headline for 2 years, and I think it just kind of had to settle out and find its price. And now I think investors are trying to find value in the market, and they're saying, hey, don't forget about NVIDIA. They still have just got this massive lead on everybody else, and it doesn't seem to be going away anytime soon.
Where else do you see opportunities in the markets?
I think more internationally, we've increased our exposure in some of our model allocations, which some of our clients are into international, into gold, emerging markets. So we're just trying to find pockets of value in the market, more broadly speaking than just looking at domestic, and certainly looking away from just technology.
And when we're talking about maybe a hedge, what's your thoughts on gold as being the hedge?
Yeah, I mean, we have a gold position in those model portfolios. We think there's a place for it. I know it doesn't pay anything. There's no yield, but it's been a long-standing hedge against economic downturns and recessions, and so we feel like it's prudent to own a piece of that. So we're not overexposed to it. We do have a small position in the model portfolios that we're quite comfortable with right now.
What about long-term duration government bonds as a hedge as well, just before I let you go?
Well, I think that's really where people are probably more exposed than they think. We would not want to see people tie up in super long-term bonds, especially with this new kind of consternation about rate hikes. That would really be a disaster for that type of trade. I think the one area where a lot of people out there, they just might be sitting on a lot of cash. Money markets used to yield quite a bit more than they did now, and so people are just naturally complacent, and so they probably should be thinking about extending into fixed income, or even if they've got the risk appetite to buy equities when there's opportunities and get out of some of that low yielding cash.
Mm-hmm. Okay, we'll leave it there. Ryan Bellinger, founder and managing principal at Claro Advisors. Appreciate your time this morning. Thanks for joining us.
Have a great day.
You too. Coming up, from scams to misinformation, we'll tell you why more and more Canadians are having a hard time separating fact from fiction when they're online. More on that after the break. Stay with us. If you feel like you can't trust what you're scrolling through lately, you are certainly not alone. A new study from StatsCan shows 6 in 10 Canadians are now very or extremely concerned about misinformation spreading online, with many struggling to separate fact from fiction. For more, here's CTV's Heather Wright.
I am not Morgan Freeman, and what you see is not real.
The line between what's real and what's fake is getting blurrier. According to a new survey, 80% of Canadians saw news or information online they suspected to be misleading or false at least once a month. And nearly half of Canadians say they are finding it harder to distinguish between fact and fiction.
What I think is more worrying is not the misinformation people see online that they recognize as misinformation. It's the misinformation they see online and actually believe.
Angus Lockhart is a policy analyst at the DAIS, a think tank at Toronto Metropolitan University. He says while the spread of mis and disinformation has been increasing for years, AI is making it easier to create fake or misleading content, specifically deepfake videos.
We're seeing very quick rises in the number of deepfakes that are posted and shared online. And that's one of the scariest ones because that technology is only getting better and only making it harder to judge what's real and what's fake online.
The misinformation survey also found more than 60% of Canadians are very or extremely concerned about online misinformation. But experts say not enough is being done by the government or by big tech.
Unfortunately, there is a lack of scrutiny on these big tech companies.
Ahmed Al-Rawi is a communications professor at Simon Fraser University and says social media companies have shown an inability to police the content that's on their platforms. And more onus needs to be put on the government to enact stricter rules.
The only language they understand is the language of financial penalties. So once you send warnings regarding these penalties, I think they will start listening.
Experts say it is vital to fact-check information found online, especially on social media, though they acknowledge that is something that's getting harder to do.
We've been watching shares of Algoma Steel after the company continues to face ongoing challenges from U.S. tariffs and a widening net loss. According to the CEO, Algoma is repositioning itself from a cross-border commodity producer to a Canadian-focused supplier. And we got more from Ian Gillies, Managing Director at Stifel Canada.
A lot of the weakness is tied from the tariff environment. The company produced about 225,000 tons in the quarter. And if you think about where this facility could be producing, if the border was open, they could probably be something closer to 600,000 tons right now. And once you start losing scale, even with an electric arc furnace, you start to lose some profitability. So I would still primarily tie it to tariffs and less so to the EAF transition.
Interesting. Okay, so I do want to talk about tariffs in a moment, but I do want to stick with this transition, even though I take your point, it maybe wasn't the main driver here. Do you still, maybe can you explain the transition first to the blast furnace operations instead?
Sure. So for over 100 years, the company had produced using a basic oxygen furnace. It's an older technology. The margins are typically less certain, just given the number of inputs into it. And the company made a decision a number of years ago to switch to an electric arc furnace, which uses recycled scrap steel. The margins are a bit more stable. Typically, the valuations are a lot better for these businesses. The company had planned to go through a multi-year transition from the BOF to the EAF. They've significantly accelerated that timeline. They shut down the basic oxygen furnace in January because it was no longer economic. And so that's why you've seen them incur costs of, call it roughly $90 million in the quarter due to this accelerated transition to the electric arc furnace.
Do you think the shift away from the blast furnace operations is the right move long term then for the company?
Wholeheartedly. When you look at the way an electric arc furnace can run, there's more flexibility in the operations. They tend to have more stable cash flow streams, which inherently drives a higher valuation multiple. And then on the altruistic side, it reduced emissions by 70%. And with carbon taxes rising in Canada when they made the decision, it was quite frankly a no-brainer.
Shipments dropped sharply in this latest quarter. I'm assuming part of that, at least, is from the tariff environment you were talking about off the top. Revenue also dropped sharply. How do you explain the increase in share price despite these results?
Oftentimes for stocks, things just have to go from being bad to less bad. I would suggest the liquidity position for Algoma exiting the quarter was a bit better than people would have expected. We're still expecting the business to get back to break-even EBITDA by Q4. And then along the periphery, even though this might not be seen in the Q1 numbers, there's a lot of positive changes happening. There's the defense spending program being put forth by the Carney government. That should be a material driver of steel demand, to which Algoma should benefit. The company's looking at a beam mill, which would be another additive piece of the story. And then as we go through CUSMA negotiations this summer, it's obviously uncertain what will happen, but it's also hard to see steel tariffs getting a lot worse. And so if you have a bit of imagination for this business and you look out a number of years, you could easily see EBITDA getting back to $300 or $400 million just based on a variety of these initiatives.
Okay, so you mentioned the Canadian government offering some support to these companies and to this industry. Do you expect more support from the Canadian government, especially during this kind of transition period in Canada's industrial sector?
At this point, the company doesn't need any additional financial support. They exited the quarter with $550 million of liquidity. We think that will get them through at least the next federal election in the U.S. There might be derivative support by the way of contract awards from buying their steel, but they're going to sell that steel to someone. So if there is additional support, it won't look like it did through the financing package we saw towards the end of last year.
But at the same time, you also mentioned just how much the tariffs have been hitting this company hard. I wonder if you can explain in more detail. I know you were talking about it off the top, but just the amount of pressure companies like Algoma Steel are facing when it comes to the tariffs and the tariff situation.
Yeah, certainly. So, I mean, in the way I would think about that is that if you look at this time last year, roughly 55% of the company sales came through the United States. They've repositioned the business, so now it's only 28% of sales. Tariff costs last year were hundreds of millions of dollars. This quarter, they were down to $27.5 million. So it's clearly been very punitive to the point where they've had to cut the production in half at the facility.
Wow. Given its current focus on expanding market share in this area, how do you think the company is positioning itself at this time within Canada's supply chain?
So they are the Canadian champion for Canadian steel production. If you look at the industry here, they're the only Canadian domiciled steel mill. The other two major steel mills are owned by an American company and a European company. So as a result, we anticipate that Algoma will be the Canadian champion for Canadian projects. We're already seeing some early signs of that. As you think about the Canadian sub awards that may come later this year, early next year, Algoma has already been awarded a $250 million grant from Hanwha, $200 million of which will be to build the beam mill, another $50 million in product orders. The company recently announced another JV with a private company outside Toronto to build armored vehicles. So the early signs are clearly there that they are going to be the defense champion.
That was Ian Gillies, Managing Director at Stifel Canada. Still ahead, we will head to Beijing for the latest on Taiwan taking the spotlight as Donald Trump meets with Xi Jinping. More on that after the break. Xi Jinping has warned Donald Trump that Taiwan could lead to clashes between the superpowers, calling it a highly dangerous situation for the world's biggest economies. For more, we are going to take you to Beijing, where we are joined by Bloomberg's Anne-Marie Horton, who's been listening into all of this. Anne-Marie, good morning, or I guess good evening where you are. I guess tell us, first of all, more about this kind of interesting forewarning from Xi Jinping about Taiwan.
Well, the timing we heard about was very interesting. President Trump and Xi Jinping were still in the bilateral meeting. We had just left them outside the Great Hall of the People, where Xi Jinping had a very warm welcome for President Trump. And then through the Chinese media, we got a readout that President Xi discussed Taiwan with President Trump and said if this relationship is mishandled, it could lead to potential conflict or a dangerous situation between Washington and Beijing. And then hours later, we got the White House readout, and there was no mention of Taiwan. Clearly, this White House wanted to focus on some of the wins, the agricultural agreements that they discussed potentially. And we are seeing some licenses for imports for beef from America into China already in a sign of goodwill this evening. On top of that, they discussed energy purchases as well as Iran. According to the White House readout, Xi Jinping said he doesn't want to see a militarized Strait of Hormuz. He doesn't want to see a toll. And the two agreed on making sure Iran doesn't have a nuclear weapon, but there's no mention of Taiwan. So, of course, that is why this has become really one of the major talking points of the trip, even though for the most part, and the two just had a banquet and had a toast together. President Trump invited Xi Jinping to the White House in September. Very warm ties, optimistic tones when it comes to business deals. But obviously, there is still tension between this relationship when it comes to Taiwan. We should note, though, that that is not necessarily uncommon. All presidents, Chinese presidents, would bring this up in any meeting with the United States.
Okay, so maybe expected to hear a little bit more about that. So you mentioned there was trade discussed, maybe some trade deals. Iran was discussed. What about the CEOs that accompanied Donald Trump on this trip? We were talking about this yesterday. NVIDIA's CEO tagged along last minute. Boeing's CEO is there. Have you heard anything from any of these big names that went with Donald Trump?
Well, one of our colleagues spoke to Jensen Huang, who was talking about how everyone's watching this meeting. It was a fantastic meeting. And Reuters had a report that the United States had approved the sale of H200 chips to Chinese companies like Tencent and Alibaba. But we already knew that back in January when this administration made a U-turn to allow the H200s. The issue was China wasn't allowing their firms to buy them. So I think going into tomorrow, that's going to be a critical question. Has China lifted some of these holds they have, blockades, if you will, on a number of issues that the United States actually were allowing? So I think that's something we're going to be on the lookout, especially as the two might discuss some sort of technological channel to discuss artificial intelligence.
Interesting. Okay, we'll leave it there. That's Bloomberg's Emery Horton joining us from Beijing. Emery, thanks for that. Appreciate it. Okay, we're going to take a very quick check on the markets before we wrap things up here. We'll just take a look at U.S. markets to start the day before the opening bell, which is just coming up. You can see mixed pre-market trading. The Dow up almost a full percentage point. And again, markets are opening in just a few minutes. Opening bells are next, so stay with us. We'll be right back. Here are the opening bells. At the Nasdaq, Cerberus is ringing the opening bell today. On the New York Stock Exchange, Blackstone Digital Infrastructure Trust is celebrating its initial public offering. It's time now for the first 15. This is BNN Bloomberg trading just getting underway. So we're going to check in on the equity markets to see how things are faring today. The TSX starting the day on an upward trend after losing quite a few points yesterday, up 0.3% at the moment. The S&P 500 also up, continuing after a bit of a rally over the last couple of days, seeing some new record highs, and the Nasdaq ever so slightly up at the moment as well. We're watching a couple of companies on the TSX, of course, as usual. Canada Goose is one of those. It's reporting fourth quarter earnings that beat estimates, with total revenue increasing almost 18% from a year ago. Canada Goose starting the morning up more than 7%. So we'll continue to watch that one for you. Canadian Tire, a different story over here. This company says sales slipped in the first quarter as a slow start to spring hurt sales of seasonal and gardening products. And in a statement from the CEO this morning, the CEO said Canadian consumers remain resilient yet selective, prioritizing value at this time. And Canadian Tire down almost 4% to start the morning on that earnings note. Keyera is another company we're watching. It swung to a net loss in the latest quarter after a maintenance outage in Alberta, of course, throughout this quarter, and acquisition costs related to buying Plains All American Pipeline's Canadian assets. And Keyera down ever so slightly this morning by 0.4%. And for movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, it's great to have you. Good morning.
Good morning. Happy to be here.
We're going to start with Cisco today. Stock is soaring on sales forecast. Tell us more about what Cisco is saying in this latest report.
Yeah, Cisco is up the most since 2011 right now. If it ends here, it will be the biggest one-day move since 2011. So pretty dramatic move higher, about 15% right now. Cisco had results. They were better than expected. The forecast was better than expected. And they are looking to cut about 4,000 jobs, which is about 5% of the workforce. So just to give a flavor for how much better than expected the results were. Sales forecast is $1 billion ahead of where the street thought it would be. So the shares are moving sharply higher this morning. This is the top performing stock in the S&P 500. And a big part of the reason here, you might guess it, is because they are expecting to sell more to data centers and pivot a little bit harder into the AI build out. And so that, as we've talked about many, many times, has produced a pretty substantial move higher in the stock so far this morning. This is not kind of a new entrant in that space. This is a long-time Silicon Valley company, but the amount of sales that it is doing into that AI market is apparently ratcheting higher this morning, and so is the stock, about 15% higher as I'm seeing it right now.
Wow. All right. We'll keep watching that one. You're also watching Take-Two Interactive, which is was rising in the pre-market. I'll check what it's doing right now, but this is because of some Grand Theft Auto chatter. So tell us more about that.
That's right. Yes, this is one of the few companies perhaps rising not on AI news. So Take-Two Interactive Software. This is a gaming company, and they have a new video game. Apparently, according to, now this is still a little bit tenuous, social media posts that are expecting Best Buy to begin taking pre-orders of a video game, Grand Theft Auto 6, and that alone is causing the stock to move up 6.7%. Making it the second best performer in the S&P 500. Quite a pretty dramatic move higher for this stock. There's a note out from Mizuho Securities saying that it's tough to overstate how important this game is to this company. This is the most expensive game it has developed. It took longer than a decade. And so if it does pull this off, and if indeed Best Buy is taking pre-orders, which is not confirmed, then this is a pretty substantial move for this company. And as I mentioned, it is the second best performing stock in the S&P 500, would be the tops if not for that giant move higher from Cisco this morning.
Wow. Okay. Interesting stuff. We'll leave it there. Bloomberg's Jeff Morgan joining us as always. Jeff, thanks so much.
Thank you.
Coming up, we've got the latest snapshot of the U.S. economy and some perspective on fixed income. That's next. Stay with us. U.S. retail sales rose 0.5% in April, narrowly missing expectations. The latest snapshot of the U.S. economy was released amid growing frustration over the spike in prices as a result of the war in Iran. So let's get some perspective. Joining us now is Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Good morning. It's great to have you join us.
Oh, good morning. It's always a pleasure. Thank you.
What do you make of these latest retail sales increase numbers? Is the increase mostly just due to higher prices?
No, it's not. And actually, the increase is broad-based. 9 out of the 13 sectors that they look at in regards to the retail sales have shown positive improvement or upwards growth or momentum in sales, in retail sales. So that's very solid. And they have a thing within retail sales that they call the control group. And that's the contribution basically to GDP in the U.S. And that came in slightly above expectations. So overall, a very solid number and comforting from an economic perspective.
Right, because I guess when you look at the CPI numbers we saw earlier this week versus these numbers today, where does that leave us then, I guess, when you're looking at the U.S. economy?
Yeah, that's a great question. And I'll kind of orient your question towards the eyes of a fixed income trader. There's 3 things that impact fixed income. One is growth, one's inflation, and the other one's monetary policy. So this number reflects growth. Growth because the U.S. is a consumer-based economy that drives a lot of their GDP. This shows that the consumer is surprisingly resilient despite the initial effects of inflation that are coming through from the war. So growth, good, check mark. That means you want to be long corporate bonds. You're all right being long, even investment grade and high yield bonds. So that's good for growth in this number. The second thing you brought up is inflation. Inflation is bad for bonds. It means you want a higher yield. And what we're starting to see with the CPI release and other numbers is a percolation now of the flow-through effect on inflation. A lot of people are calling this transitory because they believe the war will come to a resolution shortly. But if it does not, that could accelerate. So what does that mean for fixed income? It means, yes, you like holding corporate bonds, but you want shorter duration. So instead of owning a 10-year corporate bond, you want to own a 2 to 5 year corporate bond. And then the final thing is monetary policy. What does this mean for monetary policy in the US? So far, it's status quo. Why is it status quo? Because there's still an easing bias in the US. Until they change that to neutral, it's basically a green light for risk-on assets.
Okay, I do want to talk more about fixed income in a moment, I promise. But first, I want to talk about Kevin Warsh because he's now been confirmed by the U.S. Senate as the next Fed chair. But his tenure kind of begins as markets are increasingly concerned about long-term inflation risk. So do you think he could hike rates despite pressure from the U.S. president to cut them instead?
Yes, it is possible. He could hike rates. And the reason why, he is a credible Fed governor. He's not just a political animal or political machine or voice. So yes, he could hike rates. Having said that, it is a very high hurdle for him to hike rates. As I said, first they have to change from the easing bias to neutral, and they won't do that at the next meeting, June. I believe it's possible they could do that in July. And then there's a time frame. So the market is discounting a slight possibility of a hike in U.S. this year by the end of 2026. Call it roughly 10%. We believe that's appropriate.
What about the Canadian economy? Because we are expecting to get some numbers, a snapshot of Canada's economy next Tuesday. Do you think we could see a rate hike in Canada as well?
Not in 2026. The discussion will be more so for 2027. And the reason why I say that is what happened with what we saw with the unemployment release last week, or the employment release, with unemployment rate going up to 6.9%. That's something that's very important from a central bank perspective. Why? Two reasons why. One is you need a job to buy. And with less people having a job, unemployment rate rising based on the population, that means there's less dollars to buy, less inflationary drivers there. So that gives the Bank of Canada a little leeway. The second reason is you need a job to pay your mortgage and for housing. So they want to ensure that employment is stable, even though it's not their mandate. It's a secondary consideration, but it's a very important one. So we don't believe there's any hikes on the table in Canada in 2026. In 2027, it is a definite possibility.
Interesting. Okay, so now back to fixed income. Let's talk about your take on 10-year treasuries at the moment.
Yeah, we don't like 10-year treasuries at the moment. We're underweight 10-year treasuries, and the reason is inflation. And there's a thing in the U.S. called inflation expectations. It's what is the market expecting for inflation, at least investors. And right now it's around 250, and that's the highest it's been in about a year. If it goes any higher than that, which we suspect is very possible if the war in Iran is prolonged, that could drive yields higher. Above 250, however, around that 260 level, we start to like 10-year treasuries and we start to buy them. But at this level, we're at 245 right now this morning. We are underweight, but we will be a buyer above 250. 450, sorry, 450.
Okay, so then could treasury yields reach 5% this year?
It is possible. It is possible, but that would be the absolute high. We would be significantly overweight 10-year treasury bonds at 5%. The reason why we would be significantly overweight, we believe the Fed or the Treasury in the U.S. would come in and buy bonds, which is called quantitative easing, to keep the yield low. So we believe there's a lot of protection in buying U.S. 10-year treasuries at 5%.
Got it. Okay. And what are your thoughts on high yield bonds at the moment?
Right now, we like high yield bonds. We're not adding to it. We are overweight high yield bonds, but we believe the economy will continue to be resilient for several reasons. One is the tax refunds that are coming through to the consumers. That's supportive of buying, and we're seeing that in the numbers now. Also, there's still a lot of public spending going on, a lot of fiscal spending, and that is supportive. So even if we do see a pullback on the private sector, we believe that will be made up for in the public sector, and that's supportive of the market. So we like high yield. Valuations are very rich, so we're not adding. And if we rally, we will start to lighten up and sell some of our high yield holdings, but we do like it, yes.
Okay, we will leave it there. Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Always good to talk to you. Thanks so much.
Pleasure. Thank you.
Yesterday on Market Call, we were joined by Nick Mersch. He is portfolio manager from Purpose Investments, and he was covering technology stocks. These were his top picks: Micron, Lumentum, and Vicor. And today on the show, we have Stan Wong. He is portfolio manager at Scotia Wealth Management, and he'll be taking your questions on North American large caps and ETFs. So definitely stay tuned for that. Just ahead, Birchcliff Energy reported its first quarter earnings last night, and we will speak to its president and CEO on the company's performance next. Stay with us. We are looking at shares of Birchcliff Energy today after it reported its first quarter profit and revenue rose year over year. So for more, let's bring in Chris Carlson, president and CEO of Birchcliff Energy. It's great to have you join us again. Thanks so much.
Hey, thanks for having us, Lindsay.
So Birchcliff Energy it earned $70 million in this quarter. That's up from $65.7 million last year. What do you attribute to this increase here?
Yeah, so our first quarter cash flow was really strong. We actually had about $153 million of cash flow against spending of about $107 million. So the cash flow was really driven by a few things. First is strong production. Second being our gas market diversification. So we have access to premium markets in Dawn and NYMEX that represents, 55, 56% of our gas, and also on the back of lower costs. So I think when you put those three things together, we were able to generate strong cash flow in the quarter. And when we spend $107 million, we actually generated free cash flow. And so we were able to use that $45 million of free cash flow to essentially pay our debt down by 8%. So our debt at the end of the year was $460 million. Today it's $423 million, and also pay our dividend to our shareholders of about $8 million. So strong quarter, largely on the back of our gas marketing diversification and lower costs. And then as we look forward, we're really excited about what's to come. And unfortunately, with the war in Iran, that's definitely an unfortunate part. The reality, though, is when you close the Strait of Hormuz, you're seeing oil prices increase significantly. And so notwithstanding Birchcliff is a gas company, we have 16 to 18% of our production mix is oil, liquids, and natural gas liquids. So the reality there is we are benefiting, notwithstanding we're a gas company, we are benefiting from the strength in oil prices as well. And so we've increased our cash flow guidance for the year to $455 million. And that means we're going to generate more free cash flow as well this year. So, as we think about the back half of the year, again, we're going to fill up our infrastructure that is sitting there. Today, we have all these fixed costs in our business. We get to utilize that infrastructure, and that will really drive down our per unit costs and really have a rate of change story when you think about the amount of margin expansion we can get by filling existing infrastructure, and the cost structure improves into the end of the year and into 2027.
As you mentioned, you flagged strong oil prices moving forward, but weak AECO gas. And given how much you're weighted in gas instead of oil, how concerned are you about that side of things?
Yeah, so AECO gas, I know there's certainly disappointment, us included, in terms of where the AECO price is. I think the reality of a lot of Canadian gas producers is we've had to diversify over a number of years away from AECO. And so if you look at Birchcliff specifically, we would have, 56% of our gas production is sold in U.S. markets. So our exposure to AECO is 40 to 45% of our gas stream. So just on a gas basis, we've got significant diversification that reaches NYMEX-based pricing and Dawn pricing in Southern Ontario, which were really strong in Q1 and look to be, I'd say, quite reasonable as you move out into the back half of the year. And Dawn storage levels specifically, because it was so cold out east at wintertime, the draw on the storage levels at Dawn was I want to say record, but hasn't been this low for a number of years. So the demand for gas out east to fill that storage back up leading into the next winter will continue to drive stronger prices out east, which is where we sell a good chunk of our gas. And then in addition to that, you referenced the liquids. I think it's underappreciated. Some of the Montney companies, us included, that have 16 to 18% of our production mix is liquids. And so we will benefit from stronger oil prices and stronger propane prices and butane prices and all the other liquids we produce along with that gas.
Your production guidance, though, remains unchanged. Why not raise it?
Yeah, so I think the production is on track in terms of where we're at. So today we're going through a turnaround at our major facility out at Puskapay. That will be done here by mid-end May. And then after that, just the way that the capital program is laid out, we're drilling wells throughout the year and we add production into the back half of the year to fill up that infrastructure. And so today we're actually just starting on our liquids weighted part of the program. And that's historically because summer gas prices have notoriously been weak. So we'll drill our more prolific, drier gas wells at the beginning of the year. And then as we move into the summertime, we're now marching ahead with our liquids rich and oil program into the summer. And that will then drive strong economics as we fill up that existing infrastructure near the back half of the year. So I think everything is going as per plan, and we'll see where we end up in the back half of the year with respect to production.
So we talked about some of this already. You're reducing debt, buying back shares, and paying a dividend. Of these three, first of all, what's your top priority, and what can shareholders count on if things do become more challenging in the future?
Yeah, so for us, our goal this year is to fill up that existing infrastructure. We get a huge benefit in terms of our cost structure. So we improve our net back by $1.15 to $1.25, which translates into 2027 free cash flow of an additional $50 million. We also improve our margins at that gas plant and through that infrastructure by about 8%. So that's priority one. Is in this intermediate period this year, we're looking to fill up that infrastructure. We'll continue to pay our debt down and pay that sustainable dividend. That's been the mantra, and that is the strategy moving forward. That continues. However, we have been opportunistic with the NCIB or the share buyback. And so you saw subsequent to Q1, when all the funds, institutional funds moved into the oil companies with the war in Iran, the gas companies, us included, were sort of left behind, to be honest. And our multiple and our value fell way below our intrinsic value. And so that was an opportunistic purchase or an opportunistic time for us to step in and buy the shares because we think they're significantly undervalued.
Do you have any plans to kind of increase customers overseas or increase where you ship natural gas to?
Yeah, we're part of the Salisbury LNG project. So today on our west coast, we have the LNG Canada facility, which phase one is up and running for about 2 BCF a day. There's a couple other smaller projects that are FID'd and under construction. And then there's the Salisbury project, which we're part of, which is a 1.8 BCF a day facility for phase one. So we would be one of the founding members of that consortium. And again, we're working towards an FID over the next while on that project. That project is on the major projects list from the federal government. So there's a whole bunch of momentum in behind the Salisbury project, which would allow us and other Canadian producers then to access world pricing. So that's sort of the next evolution for us when you think about global pricing. And then, Lindsay, at the same time, we're looking at further diversification of our gas just in North America in general. So, we always want to have a portion of our gas at AECO. But we are also looking to have a portion of our gas at Dawn, NYMEX, and other hubs such as Southern California that are of interest to us to just continue to move gas from a supply basin in Western Canada to the demand basins, whether that's Ontario, down in the U.S. at NYMEX, or even California. So we're always looking for further market diversification.
Okay, we are out of time, so we're going to have to leave it there. Chris Carlson, President and CEO of Birchcliff Energy, thanks so much for joining us today. Coming up next, Prime Minister Mark Carney is expected to announce a clean electricity strategy that will double Canada's electric grid capacity by 2050. More on that after the break. Sources tell CTV News that Prime Minister Mark Carney will announce a clean electricity strategy this morning that will amount to the biggest build-out of the national grid in our nation's history. For more, we are joined by CTV's Jeremy Sharon. So, Jeremy, good morning. Prime Minister is slated to announce this long-delayed clean energy strategy this morning. What do we know so far about it?
Yeah, Lindsay, as you've touched on, we'll learn more this morning when the Prime Minister makes this official. But what we have learned through sources is that the federal government will announce its clean energy strategy and lay out a plan to double grid capacity in the country by 2050. By doing so, they'll create, they say, 30,000 jobs by 2028, and they'll be able to reduce the price that Canadians are paying for electricity in 70% of households by 2050. We're looking at a significant build-out of grid capacity and infrastructure, as you've touched on, things like hydro, nuclear, renewable infrastructure projects that will move ahead. And what we are told, what sources tell us, is that this whole plan, the strategy, leans on four pillars. The first, building the infrastructure needed to be able to double the grid capacity. The second, connecting the country's grids through expanding existing and building new transmission lines. Hiring the staff, of course, to do all of these projects, to build all of these projects. And then also ensuring that more of the technology and components that will power the grid are being manufactured and being produced domestically. So trying to benefit our own domestic economy as much as possible through this project. The idea is for this to be a significant build-out, of course, of grid capacity. And this is required, Lindsay, because of electrification. We're seeing more electric vehicles. And then when you look at infrastructure for things like, AI data centers that are requiring big time on electricity, this is something the federal government is committed to doing. And climate activists say is required if the federal government is to meet its emissions targets.
Wow, interesting stuff. We're going to have to wait and see exactly what he says in this announcement. CTV's Jeremy Sharon joining us live. Jeremy, thanks for that. Just ahead, the AI trade is top of mind for investors once again, and a highly anticipated AI-related stock debuts on the NASDAQ. Stay with us. More on that after the break. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. At a state dinner in Beijing, U.S. President Donald Trump and Chinese leader Xi Jinping agreed the Strait of Hormuz should remain a free waterway, adding that Iran should not be able to exact payments for the use of shipping lanes. Trump says the Iran war and the status of the crucial waterway have loomed large over his high-stakes trip to China. He is seeking Xi's help to end the Middle East conflict and says he had a positive and productive meeting. Shares of Canadian Tire are in the red today after the retailer posted second quarter results that came in weaker than expected. Softer consumer spending weighed on sales at its core retail business, resulting in revenue and profit both missing analyst expectations. Canadian Tire says sales growth at Sport Chek and Mark's helped offset weakness at its flagship Canadian Tire division. And Honda has confirmed it is indefinitely suspending development of its planned electric vehicle project in Ontario. The auto company says this comes amid weakening EV demand and changing U.S. policy. Honda is shifting its strategy toward hybrid vehicles, and the announcement comes as it posted its first ever full-year loss. Honda says the loss is partly due to the high costs associated with its EV transition and policy changes under the Trump administration. And we're, of course, watching the TSX today as well, seeing ever so slight gains after quite a loss yesterday to end the day. U.S. markets also mostly in the green this morning. You can see the S&P 500 up by 0.3% after reaching some record highs yesterday. The Dow Jones also up and the NASDAQ. And we're also watching the price of oil today. It is down 0.2% at the moment. This comes as Donald Trump and Xi Jinping hold talks in China, as we told you about. And the war in Iran remains in limbo at the moment. But as we mentioned, there was some discussions about what might happen there. Also watching the price of gold today, it is holding steady as investors continue to weigh the Federal Reserve rate path as well moving forward. It's down ever so slightly, 0.2%. And then we're also watching the loonie today, falling after the Bank of Canada released its April minutes yesterday, pointing to the need for tighter policy in response to higher energy prices. Welcome back. We are going to take you to Ottawa now, where the Carney government is announcing an expansion of Canada's clean electricity investment tax credit. We will listen in live now to some of that announcement before the Prime Minister begins speaking.
And we know that we need to go further and faster. And on that, I'm passing it to the Prime Minister with the exciting news for today. Thank you.
Good. Thank you. Thank you. Thank you very much, Julie. Bonjour tout le monde. Thank you, Julie, for Minister Jabruzen, for that introduction, for your leadership over the course of the last year and going forward. Russ, I'd like to thank you for joining us this morning with your enthusiasm for today's announcement, today's task, or today and tomorrow's task, and for your workers to deliver, make sure that Canada can deliver on it. And we need to deliver because Canada is facing major challenges from a rapidly changing world. Les États-Unis modifient radicalement l'ensemble de leurs relations commerciales.
United States modified their commercial relationships.
La guerre fait rage au Moyen-Orient et en
There's a war in Middle East
qui fait grimper en flèche les prix de l'énergie partout dans le monde.
Increases the price of energy throughout the world.
Commence à transformer notre façon de vivre
and
et de
this transforms the way we work and live, and with the requirement in energy, climate change,
les inondations plus importantes et les feux de forêt plus dévastateurs.
And also with forest fires increase. It's very important that Canada develops its resilience and brings its contribution.
Canadians are feeling all the impacts of these big changes at their kitchen tables, at the pumps, on the factory floors, as costs rise and uncertainty casts its heavy shadow. The good news is that many countries, unlike many countries, we can control our future if we seize this moment. And that means applying several lessons that these big forces have revealed. First, when the world fundamentally changes, we must respond with new approaches. As the Canadian Marshall McLuhan described 60 years ago, an age of anxiety is caused by trying to do today's job with yesterday's tools and yesterday's concepts. Canadians get that. Canadians get that, which is why they're changing how they shop, where they travel, and how they come together. And governments must now follow their lead. The second lesson is that in a much tougher world, we have to take care of ourselves. And the right path, as this government has stressed, the right path forward is to build big and to build for all, with code, copper, and steel. And to that end, Canada's new government has been moving fast. We've already referred 21 nation-building initiatives to the Major Projects Office, projects that will connect, diversify, and propel our economy through over $125 billion in new investment. L'année dernière, the construction of a
new nuclear station in Ontario started. We have sent, and also we started the contractor
a été lancé quelques mois après
this project was launched
au pouvoir.
after we came to power.
Le projet de route de la vallée
This
de
summer,
Mackenzie dans les territoires de Nord-Est.
we'll launch a project of the valley of the Mackenzie Valley.
J'attends parler depuis mon enfance.
A project that I've been hearing about for a long time.
We've created
doing
a new
it.
agency, Build Canada Homes, to drive affordable home building at a pace not seen in generations. Over $50 billion to our Build Communities Strong fund, for hospitals to hockey rinks, and a new defense industrial strategy that will catalyze $500 billion in investment in Canada over the next decade. Now, the third lesson that we must take from the current rupture is our sovereignty, our sustainability, our prosperity will depend on our ability to supply and control our energy. We have to unlock Canada's full potential as an energy superpower. As the head of the International Energy Agency, Fatih Birol, said just last week, Canada has, and I quote, a golden opportunity to build a more sustainable and reliable energy system. This will require bold investments, practical solutions focused on results, not rhetoric, and the full force of a united Canada working together. Working together to build a stronger, more resilient, more independent Canada that works for all. That's our mission. And as the minister just said, central to that mission is more electricity. As our industries expand, our economy grows, AI accelerates, electricity demand in Canada is expected to double by 2050. So we will double our grid. That's the headline. Canada will double its electricity generation over the course of the next 2 decades. Because the path to affordability is electrification. The path to competitiveness is electrification. The path to net zero is electrification. Electrification underpins everything: our emissions, our environment, our economy. Et dans un monde en évolution rapide, le Canada prend son
which evolves very quickly.
Grâce à notre
Canada
nouvelle
takes
stratégie
its
nationale
future,
de
and this is the new
nous bâtirons rapidement et à
Canadian
grande échelle
national
pour doubler
electricity
notre réseau énergétique
strategy
et bâtir
to
un Canada
double
fort qui sera
our
alimenté par
input
une
in
énergie
electricity
propre, abordable et fiable.
with clean
Over the
energy
coming
and
decades,
affordable.
Canadians will use more electricity because many of the things we use every day, the cars we drive, the heaters in our home, the machines in our factories, are switching to electric power. Doubling our grid to meet that demand won't be easy. The scale is huge, the timeline is short, and the task of getting the right mix of power is complex. If we get it wrong, Canadians will pay higher utility bills. If we're too timid, Canadians will end up short of power, losing good jobs and growing reliant on foreign suppliers. We can't pursue business as usual. We can't simply rely on restrictions and prohibitions. We must do things differently. Now, with the right investments and electrification measures, 7 in 10 Canadian households will pay less for their total energy by 2050. That's $15 billion back in the pockets of Canadians. And that's because electric machines are 2 to 4 times more efficient than those they replace. So, as we electrify our transportation, our buildings, our industry, the electricity slice of the overall energy pie grows, but the size of the entire pie shrinks. Now, Canada starts from a position of strength. We have amongst the lowest electricity costs in the world. Our system is already 80% non-emitting. Doubling generation in the next few decades will require those massive investments. It will require the linking of provincial systems. It will require the spreading of costs over time using our AAA balance sheet so that ratepayers don't pay all of the costs of investments today for benefits that Canadians, all Canadians, will benefit from and our planet will benefit from over decades. Getting this right requires permitting reform, new partnerships with indigenous peoples, and a willingness to use a wide range of energy, including hydro, nuclear, wind, solar, some gas, carbon capture, geothermal, and beyond. Il faut savoir que notre réseau électrique émet aujourd'hui un peu moins de 50 mégatonnes, tandis que les émissions des industries de transport et des bâtiments dépassent largement les 500 mégatonnes.
Exceed 500 megatons.
De loin, le plus important consiste
This is the
réduire
most issue, the
les
most
émissions
important
à un coût raisonnable
to reduce
grâce
emissions.
à l'électrification et non à la pureté absolue de la production, la génération.
With increased production in electricity.
L'électrification ambitieuse
The electrification policy
les émissions jusqu'à
aims to reduce
5
emission to 5 times
par rapport au
times
total actuel des émissions liées à
compared to the
l'électricité.
reduction, the actual
To repeat,
reduction.
By far, the
I
biggest
repeat.
prize is reducing emissions affordably through electrification, not pursuing absolute purity in generation. Aggressive electrification can reduce total emissions by up to 5 times current total electricity emissions. Our partnership with Alberta demonstrates the value of working together to solve multiple challenges. Building on our November MOU, Canada and Alberta have recently signed a cooperation agreement to get major infrastructure projects built faster. And Alberta has committed to reduce methane emissions by 75% over the next decade. We'll announce tomorrow an implementation agreement which includes strengthening industrial carbon pricing to send clear investment signals and to reward decarbonization. This is essential to our clean electricity agenda. To create the conditions to build the clean grid of the future, we need a carbon pricing market that actually works. We will also advance potential pipeline to transport at least 1 million barrels of low-emission Alberta oil a day to new markets. As a prerequisite to this project, we're progressing Pathways, a project that would enable Alberta to export some of the lowest carbon intensity oil in the world while creating an entirely new industry of carbon capture. And we're both committed to exploring new sources of energy, including nuclear, and a more efficient system that connects with neighboring provinces. We need to take the same pragmatic approach of partnership across the country to build new hydro, new nuclear, renewable power, all at scale together. That's hydro in Quebec, Newfoundland, Manitoba, BC, and the North. Nuclear in New Brunswick, Ontario, Saskatchewan, renewables in the Maritimes and all across Canada. To those ends, Canada's government is launching today consultations on our new electricity strategy. And over the next few months, we'll work with provinces, territories, Indigenous peoples, utilities, unions, to identify the actions needed to double our grid most effectively and affordably. The strategy rests on 4 pillars: build, connect, train, and make. And first, as you've heard us say before, it is time to build. We need to build more transmission lines, more transformers, more wires, more power. Alors, nous accélérons déjà la mise en œuvre.
We'll accelerate the implementation of this program on clean energy to increase thousands of megawatts to the network, to the grid. These are essential to the electrifications with income tax credits on investment who will benefit the country more than in all the G7 group. With
proposing to augment all of these, including adding the new investment tax credit for interties between provinces and within provincial networks. Which brings me to the second pillar, to connect our power in Canada east, west, north. Today, Canada is powered by many separate electricity grids, most of which aren't connected to each other. In many cases, it's easier to trade electricity with the United States than across our own country. And that fragmentation costs us billions of dollars. It means more power outages, expensive, duplicative infrastructure, and higher prices for Canadian families. It also means that many northern and remote communities aren't connected to the broader Canadian grids at all, resulting in energy bills that are 6 to 10 times higher than the national average. Fragmentation means wasted power, about 10 terawatt hours every year. That's enough to power 1 million Canadian homes for that year. Connecting grids in Europe is already saving nearly $80 billion a year, and the opportunity in Canada is just as significant. And that's why back in November in Terrace, BC, our government referred the Northwest Critical Conservation Corridor to the Major Projects Office. This is a project that will generate $10 billion in economic activity, that will connect northern communities and build a new clean energy corridor for generations. It will link Yukon's isolated grid to British Columbia's and the broader North American grid through the Yukon-BC Grid Connect, while creating that potential connection with Alberta.
Okay, we've been listening in live there to Prime Minister Mark Carney giving his long-awaited clean energy strategy, saying that Canada will double electricity generation over the next 2 decades to meet the growing electricity demand in Canada, which is also expected to double by 2050. He says this won't be easy given the scale and the timeline, but he says 7 out of 10 Canadian households will pay less in electricity by 2050. This is according to the Prime Minister. Also, that means $15 billion back in the pockets of Canadians. But the Prime Minister mentioned this means doubling production in the electricity grid. That will take investments that will require linking the provinces to connect power across Canada, as well as permit reform and new partnerships with Indigenous peoples. So we'll continue to dive into that announcement today and see what exactly that will mean for Canadians over the next 2 decades. In the meantime, though, we're going to switch gears and take things back to the markets, because the Dow Industrial Average has retaken the 50,000 level thanks to an earnings beat from Cisco Systems and following a key meeting between the U.S. and China. So we're going to get more now. Joining us is Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. It's great to have you join us. Thanks for your patience.
Morning, Lindsay.
So let's start with the Dow. Do you see it reclaiming the 50,000 level in the near term?
Absolutely. I don't see any factor right now, and this is contrary to my internal beliefs, that anything is going to stop this market at this point. If you look at the headlines that we've been dealing with over the last 2-3 months of geopolitical issues, interest rates, fast forward, oil trading at 100, you would have thought this market would have gone in the complete opposite direction. So the fact that it's defying all the rules of logic and continues to trade straight up at this point, we love to see the green on the screen, but it is certainly confusing to many of us. I think what's happening now is investors have gotten impatient with our geopolitical issues and the reoccurring headlines that have been going on, wars off, straits open, straits closed, that they've kind of pushed all of that to the side, getting back to the basics of the market, looking at the fundamentals of businesses as we're in earnings season, looking at the economic data that we get on a weekly basis that's showing us that our economy has stabilized and has gotten stronger. We have a change coming in at the Fed. We'll see how that all plays out. So again, I think investors have put all those negative headlines aside. Doesn't mean they've gone away. They're just over there. And the market continues to trade higher. So I think we are going to continue to see this trend until the next catalyst headline might take a little air out of this market.
And who knows when that will be, right? I was going to ask you if you are surprised by the strength of the markets right now. It sounds like you are, as you say, just kind of defying all logic, given those geopolitical headwinds.
Yeah, and who knows when that headline's going to come and what it is. And it doesn't have to be a major headline, right? As these markets trade higher and higher, we are all going to look for excuses to take some profits off the table. If this might be a 2 steps forward, 1 step back type of approach. I think would be healthy for our markets to get a little bit of a sell-off and maybe build another base at these levels here, even though we are at the highs. We can't go straight up. Conversely, we can't go straight down. It's not good for sentiment. It's not good for the market, and that's not how efficient markets trade. But at this point, it just seems that whatever the current headline is certainly helping our markets, and I think that the headline today is the China headline.
Yes, for sure. And I take your point that as the markets go higher, they're more sensitive to any headlines. I want to talk about Cisco Systems because shares rising after it's raising full year AI infrastructure outlook and announcing job cuts. What's your take right now on Cisco?
Yeah, it's this reoccurring theme that we're hearing during earnings season. Beats top and bottom line, revised forecast moving forward. It seems Cisco has certainly clearly beaten expectations that analysts had, and I think some of the expectations that they had for themselves. Some of their revenue and some of their top products have already beaten the estimates for 2026. Another reoccurring headline that we're seeing across the board in earnings season is job cuts, and not major slashes, but certainly reduction in headcount. Some can debate, efficiencies of AI. Some can debate whether it's just, budgeting and outlook for moving forward. But clearly, the overall theme and headlines that we're getting out of Cisco is quite similar to what we've seen to their peers during earnings season. And I think overall, earnings season has had this same type of feeling to it, where the expectations, the bar probably wasn't as set as high. They are beating top and bottom, and the outlook moving forward seems to be very rosy at this point. Again, geopolitical issues and risks and concerns that are out there, interest rates, oil pricing, this can all change very quickly. But for now, it seems like everyone feels like we're on the right path.
We're also watching Cerebras Systems today, which is debuting on the NASDAQ. Can you tell us more about this company and why it seems to be generating and attracting so much attention?
Yeah, I think there's two layers to this. One is take a step back, kind of look longer term. The yearn for IPO, the syndicate market has been out there. Companies have been waiting for a long time to find the right opportunity, the right timing to come public. And it's you could debate when is that right time. I mean, we're in the middle of a war right now, so you could debate that it might not be the right time. But I think overall, looking at their economy, this is the right time for that. And I think we haven't had, we're starting to see more and more, but we haven't seen a significant push on the syndicate and IPO market. So I think investors out there, when they see IPOs, there's clearly a lot of attraction and attention put on that. Couple that with the AI headline combined with this company, I think you put those two together, and clearly it is going to gain the attraction and attention that we're seeing right now, not only in the media coverage, but clearly in the IPO pricing that's there. This company has a significant network working with other Fortune 500 companies. Could be somewhat of it is certainly a new player in this game here, and is certainly going to have an impact. So I think this is one that we're going to continue to keep our eye on. And there's others now on the calendar. No dates set in stone, but clearly we've got large IPOs that want to come to market. SpaceX meaning one of them.
Before we wrap up here, I wanted to get your thoughts on the geopolitical front and Donald Trump's trip to China right now. We know a lot is being discussed. I just wanted to get your take on what you're hearing coming out of those meetings and what you think, how that affects the markets.
Yeah. From a PR point of view, clearly historic visit that's occurring right now, and we're seeing all the pomp and circumstances associated with that. We've got President Trump, who's invited many CEOs to accompany him on this trip, and I think that's a clear message that the Trump administration is displaying to China of, I'm bringing all my players to the table here. We want to start working together. We understand our relationship that we need to have back and forth with each other. So by bringing all these players to the table, I think it's showing very, very goodwill. Conversations about oil and the Strait and the impact and effects of that, other geopolitical issues that they're talking about. But I think the major one that we're hearing about is the issue with Taiwan. This is one that we all have been talking for quite some time. We've had plenty of geopolitical issues, Russia, Ukraine, we've got Middle East and Israel. This one here, we don't talk about as much, but it is quite powerful, this tension that's there between Taiwan and China, and our positioning supporting Taiwan, not from only as an ally, but clearly from a trade perspective and chips in which we get from Taiwan. So I think that's going to be a really key point. We can make U.S. can make a ton of progress in all these other areas. That's going to be the one that kind of gets this over the finish line here. Can they come to some understanding, some resolution, which I think is a big ask, on that relationship between China, Taiwan, and the U.S.? I think that's going to be the real differentiating factor. Right now, I'm not too optimistic about that because I think there's pretty strong views and standpoints on that. So we're going to see how that one plays out.
Yeah, we'll have to wait and see. Okay, Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. Thanks so much for joining us this morning.
Thank you, Lindsay. Have a great day.
You too. Coming up, ETFs are on pace to beat last year's record. We've got more on that after the break. Stay with us. It's time now for the ETF report. U.S. listed ETFs crossed $700 billion U.S. in net inflows this week, putting them on pace to exceed last year's record. So let's get more now from Todd Rosenbluth, Head of Research at Verify. Good morning. It's great to have you join us.
Good morning. Great to be with you.
What's driving all this interest in ETFs, do you think?
Well, we had a record year last year, $1.5 trillion. As you mentioned, over $700 billion thus far. We've seen demand for broad equity strategies, those tied to the S&P 500. We've seen demand for fixed income ETFs. More than 30% of the net inflows this year has gone into fixed income products. That's roughly double the overall assets that we've seen go into fixed income products over the years. We've seen thematic investing. It's really hard to find a spot that is not quite bright. So it's been a great time to be an ETF investor in the United States as well as in North America.
Looking at 2026 now, how are investors kind of changing their approach to defensive investing?
So on the earlier segment, you were talking about Cisco. Cisco is one of those higher quality technology companies. We are starting to see investors lean more into those higher quality companies. So the starting point for many people is the Invesco S&P 500 Quality ETF, or SPHQ. That takes the S&P 500 and slices that to 100 stocks based on the strongest balance sheets, return on equity. This is a relatively simple strategy that is, as you can see here, performed quite well this year, and investors have been gravitating towards it. So that's the basic way, but we are starting to see investors turn to some multifaceted quality products.
Okay, so let's discuss some ETFs now that highlight what's been happening in the industry. And just a disclosure, these are not buy recommendations from you. These are just topics of discussion before we get into it. So the first one is the Invesco S&P 500 Quality ETF, the ticker symbol SPHQ. Why is this one on your radar?
So it's simple. The 100 companies in the S&P 500 that have strong fundamentals. It's rebalanced on a periodic basis. You get sector diversification. So there is exposure to technology, which you'd have within the broader market, but industrials, consumer staples companies, you'd also find here. So this is, for people who own the S&P 500, this is a quality tilt to that well-known benchmark.
And you expect this one to continue going up, obviously, given what's happening right now.
You're right. So we think that higher quality companies are going to be in favor in the marketplace. You're also correct. This is not a recommendation. We think investors are gravitating towards this fund for the right reasons.
Okay, another is Victory Shares Free Cash Flow Growth ETF. Tell us more about this one. What kind of companies are in this basket?
Yeah, so this is GFLW, as I like to say, GFLW, and this Victory Shares ETF, this is a growth cousin to VFLOW, which is a more value-oriented strategy. So this looks for companies that have strong free cash flow. That's a great metric from a quality standpoint, but also growth characteristics. So you are going to see a bit more technology stocks. NVIDIA is the only of those Mag 7 stocks that you'd find within the top 10. So you're going to get diversification to other companies. This has been gathering assets. You can see we had a nice bounce back in the most recent month or so. This is a strong ETF, strong fundamentals with a growth bias.
And the Wisdom Tree U.S. Quality Growth Fund, tell us more about that.
Yeah, so this is focusing more on those mega cap technology stocks. So you're going to recognize a lot more holdings within this Wisdom Tree. U.S. Quality Growth Fund, QGRW, is the ticker. it bounced even higher. A bit more exposure to those Mag 7 stocks, but from a quality filter standpoint. So for people who want to have growth exposure, you also want to make sure that the fundamentals are relatively strong, strong balance sheets, strong cash flow generation, the ability to continue to grow for the future.
Okay, we'll leave it there. Todd Rosenbluth, Head of Research at VettaFi. Appreciate your time this morning. Thank you.
Thank you.
Up next, we'll tell you how much of the slowdown in jobs and GDP in Canada is coming from lower immigration, not economic weakness. Stay with us for more on that. Over the past year and a half, Canada has been scaling back its immigration targets. And our next guest says the recent slowdown in jobs and GDP has more to do with those demographic shifts than with any real economic weakness. So joining us now is Don Drummond, Fellow in Residence at the C.D. Howe Institute and Stafford Dunning Fellow at Queen's University. It's great to have you join us. Thanks so much.
Thank you very much.
So can you explain how immigration levels have been impacting employment in Canada, first of all?
Well, we had 3 years of unbelievably strong population growth, almost all of it through immigration. Over 1 million people were coming in per year. Our population was growing at 3% per annum. That's triple the normal pace for a long time. Based on 350 to 400,000 immigrants, typically our population was growing about 1%, and then it exploded to 3%. We actually haven't seen anything like that in Canada before. We had 1 year, 1956, where we had a similar increase, and that was the exodus from Eastern Europe, particularly Hungary, but that only lasted for 1 year. So in 3 years, and then all of a sudden we go for over 1 million people coming in, and plus a reduction in the temporary foreign workers to this new target of 350 to 380. And we've seen now a couple of quarter release from Statistics Canada saying our population actually has been declining lately. So that affects everything. It affects our employment numbers, that affect our GDP numbers. And the reason we wrote this report is we keep reading the same commentary. It's weak, it's a deficiency of demand. And we said, no, it's largely coming from the change in demographics.
Mm-hmm. Yeah, so largely coming from that change. So let's talk about how much of the weakness is coming from that change versus economic weakness.
Well, we did this mathematical exercise and said if the labor market was operating normally, i.e. the unemployment rate stayed where it is, 6.9, which is the average it's been for the last 25 years, what would the demographics and productivity trends generate? And actually generates a decline in employment this year and next. Roughly 4,500 per month this year, 1,400 next year. So if by some coincidence you saw employment drop in a particular month by 4,500, that's what the demographics would give you. Now, of course, if demand is weak, it could be a worse outcome than that. And of course, if demand is stronger, it could be stronger outcome. But that's kind of your benchmark. And so when you see like the last month where employment fell by 18,000, that's somewhat larger than would be generated just from the demographics, but it's in the ballpark of that. It doesn't necessarily indicate that demand is deficient. We shouldn't be rushing out, oh, the Bank of Canada's got to stimulate because demand is sufficient. No, our capacity of the Canadian economy is growing very slowly at the moment.
And as you say, you wrote this report because that's what you kept hearing, right? Is that the softening labor market is a result of economic weakness rather than a byproduct of slowing immigration. What are the risks of that narrative, do you think?
Well, there's certainly a big risk on the policy front because you would interpret a modest change, either a small decline or a very small increase, somewhere in that vicinity as being a deficiency of demand. And of course, the knee-jerk reaction is, well, the Bank of Canada has to cut its rate to stimulate. Department of Finance should be stimulating fiscally. Of course, if you created an increase in demand at that point, you'd be bumping against that reduced capacity. And of course, that would be inflationary. So this is very reminiscent of the periods from 1973 to 1995. Hopefully it doesn't last for 22 years, where there was what turned out to be a permanent downshift in the rate of productivity, and the policy authorities either failed to recognize it or refused to accept it. And they kept interpreting it as a deficiency of demand. We got monetary stimulus that led to an outbreak of inflation, ultimately the Anti-Inflation Board, the 6 and 5 program. Mortgage rates went to 22%. Every year the fiscal authorities would stimulate it, and we ended up, thanks to that, to a fiscal crisis in 1995. I mean, we're a long way from that situation, but it has that same kind of feel. And I notice even in describing the March, the April outcome for the employment, some get it. There was some good analysis that pointed to the demographics, but others say, oh, this is just a weak month. We expect it to get stronger. And well, exactly why do you expect it to get stronger? You do realize our population is dropping, and due to aging of the population, the labor force is dropping even more. So why would employment get stronger?
Okay, so we've talked about the impacts on the labor market, and I know you touched on this, but maybe you can go into more detail about how Canada's reduction in immigration is impacting GDP growth.
Yeah, so that somewhat different approach. Of course, to do the GDP, we have to bring in productivity, and it's a very simple assumption. Output per hour worked has averaged a 0.8 increase, so less than 1%, 0.8% since 2000. That's a pretty long term. That's a 25-year average. That's pretty robust. In fact, in the last 5 years has been weaker, so we could be more pessimistic. I'll return to that. But if we have the 0.8 and the labor market operates normally, then you would only get 0.5%, 0.5% growth in real GDP this year and next year. It would then go over to 1% for a few years, but it would settle at only 1.2% over the long term. And in the spring economic update, when finance did that long-term projection out to 2060, they used 1.5, and 1.2 versus 1.5 may not seem a big difference, but look at the level gap when you compound that all the way from 2026 out to 2060. It gives you a huge difference in the level. Now, again, demand could be stronger. Productivity could pick up, and that's what a lot of the forecasters, whether they realize it or not, and I think a lot of cases they don't realize what they're assuming, productivity would be stronger. But again, you ask yourself, why would it be? Why would it do better than the average of the last 25 years and a lot better than over the last 5 years?
Okay, and a really interesting conversation. We're going to have to leave it there, though. We're out of time. Don Drummond, Fellow in Residence at the C.D. Howe Institute and Stauffer Dunning Fellow at Queen's University. Thanks so much for your time. I appreciate it.
Okay. You're welcome. Bye.
Coming up, we've got hot picks next. We're going to zero in on the cannabis sector when we come back. Stay with us. It's time now for Hot Picks, and today we are zeroing in on 3 plays in the cannabis sector. For more, let's welcome in Kenrick Tighe, Special Situations Analyst at Canaccord Genuity. Good morning. Great to have you join us.
Good morning. Great to be here. Thank you.
Let's do kind of a quick overview of the sector as a whole, first of all. What do you feel like this cannabis sector is in right now? Kind of a more mature phase, would you say?
I think we're actually on the cusp of that next leg in terms of the cannabis sector, particularly in the US, given recent rescheduling announcements. So I think the big change here is I would perhaps characterize the opportunity in the US as something of a new day as medical rescheduling has been passed. And looking forward, we also expect high probability that we'll move forward on a broader rescheduling. So while the Canadian market is, I think, as you described it, mature, relatively mature, certainly the US and international markets, it's early stages, and I think we're at the beginning of a very exciting phase.
Okay, yeah, I was more referring to the Canadian market because I guess growth in the Canadian market is maybe slowing down, but it sounds like growth in other markets might be picking up. Is that right?
Yeah. That is about how I would frame and think of it as well. The Canadian market is obviously, finding its balance and is rebalancing as we move forward here. And certainly the international markets have helped to settle out that balance and create a bit of growth that otherwise the Canadian market wouldn't have.
Okay, let's get into your hot picks then. The first one is TruLieve, ticker symbol TRUL. What do you like about this company?
So TruLieve is the dominant player in Florida. It is also the single highest margin operator in the US. So TruLieve commands EBITDA margins in excess of 35%. It also has greater than 80% of its revenues are medically focused and is far and away the market leader in Florida. So what makes TruLieve, I think, unique is not just its commanding share in the Florida market, but just how well this team has delivered and how consistently they've delivered over time with a very, very strong lobby group, very strong operations, and frankly, a footprint that has proven very hard to beat in Florida. Hence, they're continuing to maintain a leadership position despite every competitor they have coming after them over the last 5+ years.
You're also watching Verano, ticker symbol VRNO. Adjusted EBITDA margin decline recently, but what is it that you like about this one?
Sure. So Verano has long been something of an orphan, long forgotten, didn't get the same sort of recognition out the gate as some of their peers did. Verano is in a number 2 position in Florida behind Trulieve. The Florida market, obviously being a medical market, is in focus currently on the back of this rescheduling. And I think the story on Verano really is one of, relative to peers, Verano and Trulieve are 2 of the cheapest by way of valuation in the space. Both Verano and Trulieve trade at less than 4 times 2026 EBITDA, and both have significant option value with great operations. This is a case of built from the ground up by way of the operating capability, and one of the better operators in the market today.
Curaleaf, this is a company I think most of our viewers are pretty familiar with. A beat in the latest quarter. Tell us more about Curaleaf and why you like this one.
Sure. So Curaleaf's a bit of an outlier. Out of the MSOs, it's the only one with a major presence in Europe, most notably Germany and the UK. So certainly as one looks to the US MSOs and to potential international optionality, Curaleaf moved early, they moved fast, and they built out a very, very compelling business in Europe. That is also in part reflected in their valuation. They do trade at a premium versus the group, but certainly one would look at and think in terms of that premium and the optionality that Curaleaf has done, more sooner than their peers and moved sooner in Europe, which is one of the single largest growth opportunities going forward as some of the other more established markets start to mature. It's early days in Europe.
It's interesting when you look at the industry, like at least in Canada, it seems as though a lot of these companies are shifting. There is a bit of a shift, at least, from recreational to medical use of cannabis and medical sales of cannabis. Do you see that elsewhere in the world, or is it still too early in other markets to really guess?
Great question. I think that is something we're starting to see. We've seen a launch recently of an adult use program in Switzerland. The Netherlands is deep into a pilot program, which has been running for many years. There are a number of other markets that are either considering launching of programs or migrating existing programs to recreational. It's not a straight line. Nothing in cannabis ever is. But I think the key piece here is that you are seeing movement in a number of European markets. And part of that is frankly due just to the success of Germany. It has defied expectations in terms of how quickly it's grown, how well that growth has been received, and the opportunity it has created for operators both domestically and internationally.
Interesting. And just lastly, what are some of the risks that these companies in this sector really faces moving forward? I guess it's maybe different for Canada than it is for the rest of the markets, but what are the risks?
I would hope that some of the tough lessons of the oversupply dynamics in Canada have been learned. Certainly, there is always risk that people get over their skis and we see too much product being pushed too soon into the international markets as operators chase that margin differential. One would expect, and certainly to date, people have seen better discipline than we did in the past. I wouldn't say that there isn't a risk of oversupply as these markets continue opening up, but we certainly would not expect to see the excesses of the past.
Sorry, I said that was the last question, but I just wanted to ask one more, just picking up on that point. The oversupply issue here in Canada, do you feel as though that's largely resolved at this point?
I think that the international has helped resolve some of that. So a lot of that excess has actually been absorbed outside of Canada. It's not necessarily that the Canadian oversupply problem has gone away. It's that the Canadian supply has found new markets and new destinations in which that product can be moved. And I think that has helped bring back some balance. Certainly the Canadian market is looking healthier than it has in a while. We are actually seeing modest growth out of this market. We're seeing reduced pricing pressure within the market. And on balance, it is definitely a healthier market than it has been, I would say, at any point in the last 3+ years.
Okay, we will leave it there. Kenrick Tai, Special Situations Analyst at Canaccord Genuity. Appreciate your time today. Thanks for joining us.
Thanks so much. Great.
And we're going to take one last look at the markets before we wrap things up here. We'll start with North American markets. The TSX rebounding after seeing some losses yesterday. The S&P 500 also up 0.7%. Obviously, it's on a bit of a run this week, and the NASDAQ up 0.8% at the moment. So U.S. markets really rebounding today after a number of different factors, of course. We're watching some companies within these markets as well. Cisco is one we're watching closely. Cisco Systems up, look at that, almost 14% at the moment. It's jumping the most since 2011 on sales outlook and a restructuring plan. So we'll keep watching Cisco for you. We've been talking about that a lot throughout the show because of how much it's climbing today. Take-Two Interactive is another company that we are watching, also climbing once again, up almost 7% at the moment. This comes on optimism over its Grand Theft Auto game pre-orders. There's been a lot of chatter about that over the last couple of days, and Take-Two Interactive very much benefiting from that today. We're also watching the price of oil, of course. It seems to be steadying. It's down by 0.2% at the moment after Donald Trump and Xi Jinping are holding talks in China. The war in Iran remains largely in limbo at the moment. There has not been as much discussion of that we've heard as there has been compared to the issue with Taiwan at the moment. So that's where oil is kind of lagging this morning. Gold, we'll take a quick look at that before we wrap up here. It is holding relatively steady. It's down 0.2% at the moment as investors continue to weigh the Federal Reserve rate path as well moving forward. That wraps up this edition of The Open. Morning Markets with Roger Peterson is next.